okay, and you understand monetary sovereignty, you understand how to frame policy in a quite different way than the way that is usually presented. And so we start first with the definition. And so we'll look at what monetary sovereignty is. Then we'll move to how you implement monetary policy, and then finish with the implications. So the definitions is, remember, we have a government that sets and enforces monetary laws. And so you set the unit of accounts, you set the rule for determining what a payment is, how do we settle debts in the economy, is setting a nominal payment the rule, or should you adjust for purchasing power? You also determine, of course, how we record a payment. So all kinds of rules that are set up. And it took a long time to set up these rules. Okay, this didn't come overnight. We're talking of millennia here. Okay, all the way back to, if you go to the Roman times, they had these questions of what is a proper way to set the rule of a monetary system. Okay, so one of the crucial questions that legal scholars have had was, if I borrow $100 from Aaron and I need to repay him the full 100, let's say in 10 years, okay, do I owe Aaron only $100? And then in the meantime, prices went up tenfold, okay? So the question becomes, in 10 years, should I owe him 100, or should we adjust the amount owed to Aaron by the size of the increase in prices? So should I owe him 1,000 instead of 100? Okay. And so there are lots of debates about that in legal scholar going back to Roman times. And the way different European countries answered that question varied. Okay, and England was very early, Rome in the first place, when most of the time, at least until the 3rd century AD, they went into the idea that it's a nominal value that matters. And so in 10 years, I only owe 100 to Aaron. It doesn't matter if the purchasing power of that 100 fell. The debtor is not responsible for covering that risk that is incurred by the creditor. And if you move then to medieval time, medieval Europe had, again, countries that answered that question quite differently. Some went, no, Aaron needs to pay the full 1,000. Others, like England, was very early in moving into, no, it's 100 that is owed. Okay. And over time, we moved more toward a consensus that said that we don't owe 1,000, we owe 100. And so the debtor is not responsible for covering the risk of inflation for the creditor. The creditor, if it wants to cover the risk of inflation, has to do it on his own. And so, yeah, so you set up those laws, but those laws are not imposed down, okay? They are subject to power relations. And ultimately, what you observe is where it's gonna come down to is whatever ends up satisfying the needs of government the most. And we see that especially if you go to the Roman transition toward in the 3rd and 4th century, we have a move away from nominalism, which is owing the 100, toward a more metallic view of the role of money. Okay, that would be topic for another class. Okay. And so once you have set up these laws, then you issue an inconvertible currency. Okay, and so unconvertible means you don't promise to convert your currency into anything. It's not convertible in gold, it's not convertible in silver, it's not convertible in a foreign currency, okay? The only thing that the government promises to do is to accept that national currency when people have to pay dues to the government. And those dues can be taxes, those dues can be fine, fees, tributes, okay, all kinds. And we can summarize that as taxes, okay? So that's the only promise that is embedded in the national currency, okay, the ability to pay the government with that currency. You also only issue public debt denominated in that currency, okay? So the US only issues US dollar denominated debt, okay? You tax in that national currency, okay? And so the role of taxes here is, again, to redeem the currency, okay, to return the currency to its issuer. And so the degree, some countries, you have, it's not like you are monetary sovereign or you're not, okay? You have degrees of monetary sovereignty, okay? For example, take Hungary, okay? It sets up its own monetary laws, it issues the national currency, it has public debt denominated in its own currency, taxes are in the national currency, but it also issues some public debt in the foreign currency. So if you start to have that, then you are losing some monetary sovereignty, okay? And so the more you are dependent on the availability or the need of a foreign currency, the less you have monetary sovereignty. Okay. When did it emerge? Well, it emerged a long time ago. Okay, and I don't think we went back that far, but really, you go back to Mesopotamia and Egypt. Okay, 5,000 years ago, around 3000 BC, and that's where you have the emergence of monetary sovereignty, where again, an authority was not a state authority, it was a religious authority at the time that it established a unit of account. Okay, the shekel was one of these unit of account. And the purpose of the emergence of monetary sovereignty was to compel the population to move resources toward the governing authority. Okay, and so at that time, there are Gregorian societies, okay, that are highly centralized and where religious authorities basically command the economy, okay. The grains, wheat being there at that time, a major agricultural output, the grains were stored in the temples. And if you needed to borrow grains to plant the next harvest, then the temple would record that you owe some grains to the temple. You could also borrow tools, you could borrow money, so all kinds of things like that. So everything was centralized and organized around commanding the economy and moving resources toward the king and other religious authorities at the time. Yeah. And let's see. Usually these kinds of systems, and of course that gives you a quite different story of the origins of money, at least of modern monetary system. The story is usually money emerges because of a border problem. Okay, people needed to exchange, and the problem of a double coincidence of wants is what led to the emergence of money. Well, unfortunately, there is not there is actually no evidence for that. Okay, most early societies really didn't do barter. Okay, or it was like a rare thing. Okay, what you don't see the need for money in those societies, early societies that are based on kin and close-knitted societies. Um, and so money does not emerge from the need of barter. Okay, the emergence of money, if you look at the historical record, is really, at least if you look at it in the modern version, not at what we call primitive monies, uh, is really a state story, a government story. Um, and so the monetization of the economy was driven by state needs, not by market needs. Um, usually these type of sovereignty is tax driven. So you have the establishment of an asymmetric power relation, okay, where you impose dues on others. As a sovereign, you impose dues on others that need to be paid in the national currency. And so you'd basically tell people, you are indebted to me. Why? Because I say it so. Okay. And so you have a tax liability that emerges. Okay. And when this tax liability is imposed, at the same time, the authority also promises to that you can discharge this liability by using the national currency. So of course, now the question is for the people who have this liability that is hanging on their head is, how do I discharge this liability? Well, I have to find a way to obtain that currency. Okay, and you do that by basically supplying goods and services to the sovereign. Okay, and so once you have, as a sovereign, imposed this liability, you also need to make sure that you actually enforce it, because the credibility of the debt that you're imposing is based on the idea that people really think they will have to pay that debt in the future. Okay, if they never think they will have to, then they will never think they will have to pay, so they don't accept the currency today in exchange of payment of services they provide to the government. And so you need to have enforcement. And so the enforcement means that you have a day, okay, or a time period in which the tax has to be paid, okay, it must be paid. And you pay it again with the national currency. You can also pay it in kind, okay. If you go back to the early times, okay, or not so long ago, Middle Ages, usually there were not enough coins to make all the tax payments. So the state would accept payments in kind instead. So you give bushels of wheat to the state, and that would redeem the tax. Okay. And of course, the point again is what you're trying to do is move resources to the government. Okay. And of course, you have to have a credible enforcement and make sure that people fear not paying. Okay. And so throughout the course of history, the way that was done is by fining people or putting them in prison or death. Okay. So one of the most recent case, I guess, is Wesley Snipes, that didn't pay his taxes and refused to pay and went in prison for like a few years. Okay, I'm not sure he's still there. I think he came out. Yeah. So yeah, the if the sovereign does not enforce, so that is, if it doesn't do step 2, okay, not only imposing a due, but enforcing the due. If you don't do step 2, either because you can't or you think you don't need, then the monetary sovereignty will be challenged. and you'll have problems to move resources for the public purpose. And of course, I will come back to this issue of what the public purpose is at the time, okay, and throughout most, I guess, of history, the public purpose was very narrowly defined as fulfilling whatever the king wanted. That's what the public purpose was. And so if you don't enforce the dues, then you'll have problems. So, and that comes up still today, okay? So what are the ways through which enforcement may not happen? One is if you have an unstable political system, okay? And so in this case, you have a lack of trust in the government ability or willingness to enforce the tax payments. So an example of that that we mentioned in class, this year we didn't go too much into the details of that, but you had it on the exam in the midterm, was the case of the Massachusetts Bay colonies. And remember, the colonies started to issue their own unconvertible currency in the 1600s, okay, and late 1600s. And so it's unconvertible, so they didn't promise to convert into gold or anything. The only promise was that you could pay your taxes with it, okay. Unfortunately, at the beginning especially, there was really a lack of trust in the ability of the government to do so, because lots of people were afraid that the UK would not see that with a good eye, because usually when you have monetary sovereignty, what comes quickly with it is the search for political sovereignty. And of course, Britain didn't want that. Okay, they wanted to keep its colonies. And so there was really a fear that basically the British government would clamp down on this monetary experiment and would overthrow the Massachusetts government. And if you do that, then the paper that is issued by that government is now worthless. And so you end up having provided services to the government by selling tobacco, grains, labor, and you have this paper that they gave you in exchange, but you can't do anything with it. And so what you observe then is that in the early period of the monetary experiment, there's really a lack of trust in these pieces of paper, and they do circulate at discount, okay? And so $10 note would circulate at $7, okay, or less. Okay, I think the usual discount was 30%. Okay, so $7, because there is no certainty that later on the government will be able or willing to take back that note for 10 or at all. Okay. Over time, though, as the system went and the British government did not retaliate, the confidence in the paper currency of the colonies grew, and it circulated at par. Okay, it ended up circulating at par, meaning that a $10 note would circulate at 10. Later on, the system collapsed due to the colonial wars, okay, that occurred where the colonies had to fight, well, with England, and all the other wars that led to inflation of the currency, okay, and basically it collapsed. And so there, an example of political instability. So sovereignty, monetary sovereignty, is linked to political stability. Another way through which you can have problems in moving resources by using a monetary system is because you have poor enforcement mechanisms. So you observe these especially today in developing countries, okay, where tax evasion is quite high. and where you have high corruption of tax official, okay, and where they say, well, if you give me $1,000, we'll forget about the amount of taxes you owe, 20,000, but that's fine, we'll clear that out. Okay. And so the broader the ability to evade the tax, okay, and the more poorly it is that the enforcement is, then the more difficult it is to convince people to give resources to the government, because they know they won't have to pay the tax in the first place, or they can bypass it easily. Okay. And so the demand for the national currency will be quite low. Okay. And the last reason, again, one that today is prevalent mostly in developing countries, is where you have a large informal sector, okay, where it's hard to track what kind of payments are going on, who is receiving what. And so it's hard to tax that, okay, because there's no record of anything. And so if you have that, any of those, or a combination of all of those, it's going to be much more difficult for the government to obtain the resources it wants to obtain, and you're going to have more inflationary pressures. What you'll also see is that the citizenry may not use the national currency for its transactions, private transaction. Okay, they will use the national currency only to transact with the government, and in their daily life they won't use that currency, they will use something else. Okay, sometimes it's a US dollar, for example. Okay, and so countries that sees high political instability, large informal sectors, and corruption won't have a national monetary system that works well, that is widely used, and that allows the government to spend in a way that is not creating inflation. Okay. And so, of course, the other side is that if you have a strong political system, you have strong enforcement mechanisms, then if you have a political power that extends beyond the borders, then the demand for the currency extends also beyond your borders. Okay, so the current example, of course, is the United States, and with the US dollar playing a role as the national currency, given that the fact that not only the US economy is large, but the US economy also has control over large bodies, international bodies such as the IMF and the World Bank. Okay, and so through these means, it can extend the use of the US dollars beyond its borders. The broad point here is that taxes create is a sufficient condition to create a demand for the currency, but it's not a necessary one. Okay, because people may demand the currency for broader purpose and just use to pay taxes, and usually they do. Okay, we saw that the domestic private sector usually wants to net save the currency beyond taxes. Okay, they want to use it in its own transaction usually. And it's the case if you have enforcement that is strong. So that's basically it about the definition of monetary sovereignty. Any questions maybe before I continue?
I just had one
Yep.
question. You mentioned the example of Hungary earlier.
Yeah.
They're monetarily sovereign, but they borrow in a foreign currency. Is that just because they don't have enough like private wealth holdings that like demand their debt? or is there another reason?
I think one of the reasons why countries such as Hungary and others, okay, you can think of Argentina also pegging to the dollar, why they try to do that is some of them have issues of economic development. And when you have issues of developing your economy, and you want to buy the machines, you want to buy high-tech services and all this, those usually require payment in dollars. It's hard to be able to pay with your national currency with those. And so you have two ways to go. One way is to let the private sector do that and borrow in the currency, in the foreign currency, and import those things, and you promote development through that. Another way is to have the government do it and borrow and buy the things and develop directly. What we see is that it's much more difficult for governments, once they have borrowed in a national currency, in a foreign currency, and they run into a problem, it's much more difficult for them to basically work out the debt problem, because there's no international bankruptcy laws that apply for states. And so the case when the state starts to default, it takes years and years of legal wrangling, and usually you can't get rid of that debt. And so the position that usually we take here is that if you want to have a sector of your economy that borrows in foreign currency, leave it to the private sector. The government may work with them, but leave it to the private sector, because there are well-defined bankruptcy procedures for private sectors. And so it's much easier to work out the problem if you have issues. Yep. So implementation is, well, we saw that quite in detail. Okay, we saw that we have a heavy and routine coordination between the Treasury and the central bank, okay, to make sure that government operations work smoothly without disrupting the payment system. And so heavy in the sense that there is really a very close relation between the Treasury and the central bank at all times, at all level. And it's routine in the sense that it happens every day, okay? And this routine coordination is at three levels, okay? For monetary policy, we saw that the Treasury helps the central bank to manage policy rates, okay, especially when the central bank is not able to properly perform open market operations to maintain the policy rate on target. The Treasury will come in and, at the request of the central bank, issue more treasuries, okay? And what we got out of this is that the public debt, the way it's managed, is quite different from the way it's managed in a non-monetarily sovereign government. And it's not managed also like a household or a business, okay? The fiscal side, we saw that there is heavy coordination here with the central bank helping to implement the budget that was passed by Congress. And of course, tax collection also heavily involved the role of the central bank, okay? And finally, at the financial policy side, both the Treasury and the central bank work together to make sure that there are enough safe interest earning financial instruments. So in the United States, it's US Treasuries, okay? And so again, the broad conclusion here is that the central bank and the Treasury work tightly together to ensure the stability of the economic system in spite of the fact that government spends and taxes. And so the central bank is involved in fiscal policy by ensuring that Treasury's auction are successful. Okay, we saw that in several ways. One is the central bank directly buys treasuries at the auctions. The other is by having the central bank being indirectly involved through private entities that participate in the auction and financing these private entities. So monetary financing of the Treasury is one possibility, okay, where you have direct purchase of Treasury IOUs by the central bank, if it's allowed, okay. And today we didn't talk too much about this, but there is a workaround here that exists, even though the central bank is not allowed to buy US Treasuries, okay, directly. At least not, again, it's more complicated. You can buy some, but only to replenish the one that are maturing. Okay, so, but you cannot buy just to add onto your balance sheet as a central bank. Okay, so there is a workaround though of the idea of buying a net positive amount of Treasury IOUs, which is the fact that the central bank routinely buy US coins, okay, from the Treasury. The Treasury is the one that issues the coins by giving order to the mint to stamp more of them. And during the public debt ceiling debates of 2011, there was the idea circulated that we can bypass the problem by having the Treasury issue a $1 trillion platinum coin and selling it to the central bank. Okay, and so by selling it to the central bank, the central bank would credit the Treasury General account by $1 trillion. And on its asset side, it would have this $1 trillion coin. Okay. We all usually think of the central bank as having the monetary power, but really the Treasury also has some, okay? It just over the years and decades decided to delegate those monetary power to the central bank, but it could bring them back, okay? And it still has some, mostly related to coins. Another way through which the central bank is involved in helping ensuring Treasury auctions are successful is through the refinancing of Treasury by purchasing Treasury IOUs to replace maturing one. This is allowed. Okay, so if the central bank has $100 of US Treasuries that are maturing, that is, the Treasury needs to pay $100 to the central bank, what happens is the central bank just buy a new $100 worth of treasuries, replacing the old one with new ones. Okay, and so we call that refinancing. And you have this indirect monetary financing by the central bank helping the participants in the primary markets, a major participant that participate in the auction. So in the US, we call them primary dealers. If you go to England, we call them gilt-edged market makers. Okay, so those are large financial institutions that participate in the auction that must make a bid. Okay, so the idea that, what if suddenly there is no demand for the treasuries? Well, you can't, because these entities are required to make a bid. And today's bid are so large that usually the auctions are oversubscribed. Okay, there is more demand than what's supplied. And so they're required to make a bid, and the central bank makes sure that once the auction needs to settle, then once the payments have to be made, once the purchase of treasury has to occur and the primary dealers have to make payments to the treasury, the central bank makes sure that these dealers have the money they need. Okay, how it does that is by either buying old treasuries from the primary dealers. And so the central bank buy old treasuries and in exchange credit their reserve account at the Federal Reserve, Another way is by providing them credit that is backed by old treasuries. Okay, so the central bank is always there behind to ensure that these dealers have the funding they need to purchase the treasuries that they are required to buy. Now, the Treasury is also involved in monetary policy through debt and cash management. So debt management, meaning managing the public debt to fulfill macroeconomic goals. Okay, one of the major macroeconomic goals is interest rate stability. Okay, and so we saw that the U.S. Treasuries were issued at the request of the central bank. Most recently was those special financing bills that were issued during the Great Depression. If you go back to World War II, you have the Treasury again at the request of the Fed issuing Treasury bonds. And you also want to maintain the stability of the financial system. And so in that case, you may do like we saw recently in Australia, have the Treasury issued securities even though it's running a surplus. Okay, so it's running a budget surplus, and you would think that, well, if you issue a surplus, well, would you need to borrow more money? Okay, well, it's because the public not is not managed in the same way as a household debt or business debt or state and local authority debt is managed. Okay, it's managed broadly to maintain in part financial stability, and so that may involve issuing treasuries when the government is running surpluses. Why? Because when the government runs surpluses, it sucks out treasuries out of the financial system, and the public debt would be falling. Okay, and so a lot of politicians are saying that that's what we want to do. Okay, we want to reach surpluses and pay down the public debt. Okay, we want to get rid of this burden on our next generations. But when they arrive there, what they figure out is, treasuries are central to the stability of the financial system. And if we don't issue them, there's a scarcity that will occur. Something we saw again in September 2019 when September is a corporate tax day. And so there were a huge amount of tax that were due, and that sucks out a lot of funding out of the financial market, and that created a lot of instability. Same thing in the 2000 when we had surpluses, you had a scarcity of treasuries that started to occur in the system. And so people at the Federal Open Market Committee started to think, how are we going to do this? We are going to have less and less treasuries. Remember, at the time, the idea was that we're going to pay down the public debt totally in the next 15 years because surpluses are going to last for the next 15 years. Okay, and that was a CBO projection. Remember, we talked about at the beginning of the semester where the CBO doesn't think through the implications of surpluses in the government sector and how that means a deficit, usually in the private sector. And so they were forecasting growing surpluses as far as the eye can see, and Clinton was boasting that we would repay the public debt by 2015. Okay, and so discussions in the Federal Open Market Committee at the time are really trying to assess the implications of that. And what they see is that, well, we're going to have less and less treasuries to perform open market operations. Financial market participants that use treasuries as a collateral won't have any more of that sort of collateral. So how are we going to make the system work in the absence of treasuries? And so we saw again, the Australia decided to say, well, forget it. We don't have a easily workable alternative to treasuries. So what we're going to do is, even though there are surpluses, we're going to keep issuing public debt. Okay. And so now you disconnect surpluses with the idea of paying down the public debt. You just keep issuing more according to the need of the system. Okay. And the last one is cash management. So you have transfer of funds between accounts. We talked a lot about that. Okay, where you have the Treasury moving funds between its tax and loan accounts, which are private bank accounts, and its Treasury general account to ensure that the amount of reserves in the banking system stays stable. Okay. And so an example of this here, again, we talked about that graph extensively in the past. In 2008, okay, we have the central bank in September 2008, following the collapse of Lehman Brothers, issuing large amount of reserves in the system, and lots of institutions went to the discount window to borrow reserves. Okay, huge increase to $700 billion. And so you have a $700 billion injection of reserves in the system. And if you don't remove these reserves, the Fed fund rate will fall to zero. Problem is the Fed fund rate was not at zero at the time. The Fed still wanted to target a 1% rate. And so I needed to mop up all these reserves. Problem was it didn't have enough treasuries to mop up all the extra reserve it was injecting. So it asks the Treasury to issue Treasury securities and to also move funds out of its Treasury tax and loans accounts into the TGA to remove reserves. And so as the Fed was injecting reserves, on the other side, the Treasury was mopping them out. Okay, and the idea was Treasury, the central bank would provide reserves to bank in distress. The bank in distress would pay their creditors, which are other banks, and then these banks had extra reserve they didn't know what to do with, and so it was mopped out by issuing treasuries. Okay, and so you can see you have 650 billion of issuance of excess reserve of reserve issuance and about $600 billion of treasury operations to offset. The offset was not perfect, okay, as you can see. There was about $50 billion worth of reserve left. And so the Fed fund rate did fall below target. It didn't fall to zero, but it did fall below target because there was not enough of an offsetting operation by the Treasury. There is no financial constraint, of course. So this is basically that for the implementation, how you implement today monetary sovereignty. Questions on that? No. So the implications, well, sure. Yeah.
Would inflation have spiraled out of control if if that money wasn't mopped up by the Treasury?
So in this one, what the implication would have been is merely that the Fed fund rate would have gone to zero. Again, here we're talking about reserves. We're not talking about money that is flowing into the non-bank sectors. Okay, all this is money staying in the banking sector. It's accounts of banks at the Federal Reserve. Okay, you and I are not touching this money. It's just between banks. Okay, and so this is not money injected so that people can spend it. It's just money provided to banks so they can pay other banks. That's all. Okay. And so the only implication is the Fed fund rate would have fallen to zero much more quickly. Okay. And so the Fed would not have met its Fed fund rate target. Okay. So the implications are there is no financial constraint. Okay. Through the coordination of Treasury and central bank, government can afford to buy anything for sale denominated its own currency. okay, or its own unit of account. And so two quotes here is that a government which has control over the banking and currency system can always find the cash to pay for its purchases of home-produced goods. Okay, and so emphasize here is that we have control over the banking and currency system. That doesn't mean that the central bank or the government is the only one creating money. Okay, it's just that the government sets the monetary laws, issues a national currency, and determines how payments have made all this we talked about. And it's for the purchase of home-produced goods. Okay, so monetary sovereignty allows you to buy what's available for sale in your own currency. Most of the time that occurs only in your country. For the United States, it has a broader ability to purchase things because there is a demand for the US currency that is much broader than the domestic current economy. And so you can buy more than just what's available in your domestic economy. But it has to be denominated in your own currency. If it's not, then you have a problem. There is nothing, and so here's Greenspan, there is nothing to prevent the federal government from creating as much money as it wants and pay it to somebody. Okay, so see this reference to the federal government. Okay, he's talking about the government as a single entity where you merge Treasury and central bank together. Okay. The MSG, so we're not talking about Chinese restaurant here, we're talking about monetary sovereign government, okay, cannot be forced to default on their debt, okay? That is the one that are denominated its own unit of account. Default can occur, but it's quite rare and it's purely voluntary, okay? It's not because you don't have the money, okay? The government, the implication here is that the government has control over the cost of its public debt, okay? And it can choose to enforce that control more or less tightly, okay? An interesting example today of that is, again, the Eurozone, okay? Where the ECB is reluctant to accept the fact that it needs to be much more involved in national treasury finances. And there are two laws in place that says that the ECB should avoid doing that. But at the same time, if you don't do it, the Eurozone project collapses, okay? And so this willingness not to get involved in national treasury finances got tested in 2008. And ultimately, as Stephanie noted last time, okay, the ECB noted that we'll do whatever it takes to maintain the stability of the Eurozone. That means purchasing and helping treasury auctions by purchasing treasuries in the market. Okay, and today, again, with the coronavirus, this was tested, but this time the ECB, although it was reluctant, and Christine Lagarde said that it was not the role of the central bank to maintain interest rate stability, ultimately, again, they folded, okay, and agreed to buy whatever was needed in terms of treasuries to maintain interest rate low and stable, okay? And so the ECB is an interesting case of a reluctance, willingness to coordinate with national treasuries to maintain financial stability. And so you may choose to apply it or not more tightly. In the case of the United States, again, a tight control was World War II, where the government controlled all interest rates on treasuries, long-term and short-term. Usually it prefers to follow only and control on the short side and control those tightly, while the long-term rates can move on their own more, but tend to follow quite strongly the federal fund rates and all other short-term rates on treasuries. Okay, and so broadly, the public debt is managed for a much broader purpose than just budgetary goals. Okay, and the way to manage that public debt is not necessarily consistent with budgetary goals. Again, as we said, the Treasury may issue treasuries even though it's running surpluses. Okay, it's like you have enough money to buy a house, but you prefer to take a mortgage. Okay, and the Treasury may issue high interest rate debt instead of low interest rate debt because there is a need in the market for long-term treasuries. And so even though their long-term treasuries have a higher interest rate, the Treasury will issue those, okay, because that's what the market wants, okay. And so here's another quote again from people from the Federal Reserve. It says that as a sole issuer or manufacturer of dollars whose debt is denominated in dollars, the US government can never become insolvent, i.e. unable to pay its bills. In this sense, the government is not dependent on the credit market to remain operational. And again, here we're not talking about, oh yes, it's true, the government can issue and print money, but that's not the way it works normally, and that would be inflationary. No, what they're saying is that this is what happens routinely. It has been happening for decades now. That's how the government operates, through this heavy coordination of the two main entities. Okay. And so they work together, and so you can talk of them as being a single entity that issues the currency and pays debt in that currency, buy things in that currency, and that's not something abnormal or that is inflationary by itself. Okay. Another implication is that fiscal deficits are normal and they are sustainable. Okay. Normal because usually other sector wants to be in surplus, and we know that we have this sectoral balance accounting identity that must hold. Domestic private sector balance plus government balance plus the foreign balance must sum up to zero. Or put differently, not all sectors can be in surplus at the same time. And given that the domestic private sector and the foreign sector, especially if you have a currency that is demanded abroad, this sector wants to save the currency, want to accumulate your national currency, so they want to have a surplus. Well, these two usually want to be in surplus, so well, then the government has to be the one in deficit. Put differently, there is these domestic private sector and foreign sector want to accumulate the currency, and so someone has to inject that currency, and the injector is the government. It's sustainable because a monetary sovereignty provides a degree of freedom here in this tight accounting rule here. It allows to ensure that, yes, the government has to be in deficit, but it can afford to do it financially. That is not a problem. And ultimately, what the size of the fiscal deficit will be depends on what the other sector desired in terms of net saving or surpluses, if you prefer to call it that way. And so government doesn't have much of a control over its fiscal outcomes. That is ultimately determined by the other sectors. And if the government is trying to pursue a policy that involves achieving a specific balance, usually politicians say they want to achieve a surplus, okay, if that is not consistent with the desires of other sectors, it won't be successful. So take again a case where a government says, I want to achieve a surplus, okay. And so I'll cut spending, I'll raise taxes, and try to reach a surplus. Well, this will usually not work out if other sectors want to be in surplus too, okay? because other sectors are, if you are cut spending and raise taxes, I mean, other sectors are going to go in deficit first, the first step, but then they're going to react to that. And react how? By cutting their own spending. And that will tend to generate a recession. And with a recession comes the role of automatic stabilizers that we talked about, that will then, and remember, automatic stabilizers is the idea that when government economic activity falls, government spending automatically rise without Congress doing anything, and taxes fall, again, without Congress passing any bills. And so the government balance will go back into a deficit, okay, until you reach what is desired by other sectors. And so the fiscal balance is never a proper policy goal, okay? Government should not set up a political agenda that involves trying to achieve a certain goal in terms of the fiscal balance. The fiscal balance should be whatever, left to be whatever is needed by the economy. That is not saying that MMT is for deficit. It's just saying that the fiscal balance is just whatever their other sector want it to be. So let it be. Okay, if you try to go against that, you're just going to create instability. Usually we have to have deficits. It's fine as long as you have monetary sovereignty. If you get to a surplus, there's nothing to celebrate there either. Okay, it reflects the other sector's willingness to go in deficit. Fine. Okay. And so don't then try to say, oh, well, now we can try to use the surplus of the government to make new policies. Now we have more financial liberties because we have a surplus. None of that is correct, okay? A surplus does not improve the ability of the government to do anything in financial terms, okay? So, so we talked about that, okay? Austerity policies usually won't work out unless other sectors are willing to deficit spend. And so you have no autonomy that is gained by trying to balance your budget or reach a surplus. Okay. And so we saw that by looking at some data, we saw that most of the time, all countries are in deficit. So as a stylized fact of macroeconomics, we saw that it's the case that government deficit spend and the domestic private sector is in surplus. And so those should be two key stylized facts that you take with you when you start to do macroeconomics. Okay, that these are the norms that you observe throughout the world. We saw that, of course, interest rates in fiscal policy are not related. We saw that there is no relation between the fiscal position and interest rate. The R coefficient of correlation is 0, but there is a strong correlation with monetary policy. So a key driver of interest rate is not the fiscal position, that is a high public debt and a high fiscal deficit is not really correlated with high interest rate. Okay, what you observe is instead that it's monetary policy that sets those rates. And so what that means is that the interest rate on the public debt really in the end is a policy matter. It's not something that is driven by bond vigilantes or the financial market that punishes government because it has a high public debt and is seen as not creditworthy. Okay, it's a central, why interest rates are high on public debt? It's because the central bank set the interest rate high. Why are they low? It's because the central bank set it low. Okay, so you have a policy choice here that sets the interest rate cost. And so then what becomes important is what is the public purpose? Okay, how do you decide how government should be involved? What kind of spending should it do? What should be the tax structure? How you should set up tax laws? All those are public purpose. What do you want tax to do? Do you want what are the bads in the economy that you want to remove through taxes? What should be the spending priorities of government? Those are political questions. And we saw that MMT sees a lot of socioeconomic challenges today, okay? Unemployment is a chronic problem. Unfair inequalities is another one. We have aging society, pollution. So you have a bunch of bads here, and you can use the power of government if you choose to help solve those problems. Doesn't mean that the government should do everything alone, but you can use the tool of government to do that. And the essential point is that none of this is solved through fiscal means by achieving a fiscal surplus, or putting money in a lockbox. These financial matters are not relevant to solving these problems. It doesn't mean that the government should spend like crazy and there is no accountability that government should have, because you need to manage for government spending and taxes for the risk of inflation, waste, and other problems. Okay, and so our last slide here is that monetary sovereignty does not apply only to the United States. Okay, the United States is special in the sense that the foreigners want to hold the currency, but the US dollar. Okay, what that means is that now if you go back to this guy here, this is positive, greater than zero. For most countries, this is zero. The foreigners don't desire to accumulate the domestic currency you have. So, but for the United States, this is positive. And so given that the domestic private sector balance desired is also positive, the implication is the government balance, the government deficit has to be bigger than it would otherwise have been, because now foreigners also want to accumulate the currency. Okay, that's how the implication of having an international currency, your deficits, fiscal deficit, need to be larger, because you need to have a bigger injection to respond to the desired surplus, not only of your domestic sector, but also of your foreign sector. Some economies have limited domestic resources, they have limited ability to impose taxes and enforce taxes. The foreign demand for the currency is zero. And in that case, your fiscal space, as we say, the ability of the government to spend in the economy without creating inflation is limited, okay? And so the fact that you have monetary sovereignty, again, doesn't mean that you have the ability to spend an unlimited amount, because you're gonna have these constraints that are coming on you. The key point is that the way you budget in the monetary sovereignty is not by trying to achieve a specific fiscal balance. Even if you have this constraint, you usually will need to be in deficit still, because domestic private sector will want to accumulate your currency. But you will need to budget, and that is set up your spending for the years, setting your taxes with a view of those constraints and the view that you have limited ability to spend. And so that's how the properly budgeting procedure should be, not trying to achieve a specific balance, but determine what your spending should be given the constraints you faced in the economy. And then let the budget be whatever it needs to be at the end. Okay. And so in that case, of course, the fiscal deficit will be small, and deficit spending beyond that will be inflationary. Okay, and so ultimately, monetary sovereignty doesn't mean you have a free pass. Okay, you still need to pass a budget, because you need to be accountable and transparent. And the executive branch still needs to tax for budgetary purposes, for microeconomic and macro purposes, and you still need to issue bonds for budgetary and other purposes. And what it means is you don't have bond vigilantes that are there to try to punish you if you deficit spend, because they don't have much of an impact. That you have much more flexibility to spend on goods and services, at least in your country. If you have a foreign demand, then you can spend on goods and services that are outside of your country too. And that the public debt is really not managed in the same way as household and firm debt. So you have here, again, you cannot compare the government in the same way as a household. It's a completely different animal. And so it doesn't mean you can spend an unlimited amount. And it doesn't mean also that you have to have direct monetary financing and direct monetary creation financing of the Treasury. Okay, MMT is not for changing the current way central bank and Treasury coordinate. You can keep it the way it is. It works perfectly fine. You don't have to have the Treasury, the central bank, buying directly treasuries from the central bank.